All right, well, thanks for watching my educational video on tax-free retirement planning. It's a very powerful video. I think you'll get a lot of value from this, and that's my whole goal. My name is William Ramirez. I'm a financial strategist, tax-free retirement planner. Doing this for 26 years now, which dates me back 2000. Originally from California, and moved out to Texas 4 years ago with my beautiful wife and daughter. Been studying the world's sought out investors like Warren Buffett, Ray Dalio, John Bogle, the Vanguard. Got my MBA degree in California, and I have a very, very nice group of clients in California and Texas too now. So I'm really happy here. Just to give you a little background about myself, and I'm going to proceed with the presentation, and hopefully you get some good education, so you can contact me at area code 805-587-8785 for a free consultation to get more information to make an intelligent decision based on facts, not theories, and be able to generate lifetime income and other benefits that come with this. So with that in mind, I'm going to go ahead and move forward. Where's the best place for my retirement? That's one of the topics that I've used for many, many years. And by the way, this is based on the book, the little book of Common Sense Investing, which is dated back in 2006. And that's when I put this together. And you might go, well, that's kind of old presentation. I mean, we're 2026, that's 20 years ago. You're right, but it's more applicable now than it was then, and I'll explain to you why. More money managers are underperforming the stock market. And the premise of this book is to have you understand that money management doesn't really work the way you think it does. And I'm going to expose this with using the book, the little book, Common Sense Investing, written by John Bogle. He was the CEO and founder of the Vanguard Group, a $1 trillion financial institution. So hopefully this will be something enlightening and educational. So where is the best place for my retirement? First thing you want to do is you want to be able to control and manage risk, obtain reasonable performance. I think we do that. I think you'll feel pretty good about your situation. But the problem with that, I say problem, is that most people will sacrifice yields, in other words, rate of returns, by putting them in CDs, money markets, and treasury notes, which really doesn't get you that much, because after taxes and inflation, even at 3% inflation, your return is probably more of a negative return. But you know what's interesting, while I'm doing this presentation, I heard that the government does not include groceries, gas, amongst many other things on the inflation rate. So I think inflation is a lot higher than 3% if you go to the grocery store, right? Or gas station. The other problem is people delegate it to mutual fund managers, private money managers. And the problem with that is that there's no downside protection. You know, I've been reading a lot of information on baby boomers that have a nest egg of a few $1 million, several $1 million in some case, but they're more concerned about protecting it. And what I'm going to show you is a way to protect it and not overpay your taxes. Mutual funds have no downside protection, as you can see there, And in 2001, I like to go back to history because, history repeats itself, as we know, and you never know when this can happen again. The dot-com bubble, the top mutual funds back in those days did worse than the S&P 500 index. So in other words, if you did nothing more than put it in the S&P 500 index, you would have done better than the top performing mutual fund managers. In 2008 to 2009, the Great Recession, again, the top performing mutual fund managers did worse than the S&P 500 index. Again, why would you want to pay somebody to manage your money when you can outperform them? Well, here's the problem with actively managed funds. They have no downside protection. They underperform the market. They're very expensive, by the way, right or wrong, and I'll disclose that in a moment. They lack consistent results, and these are basically studies in the little book of Common Sense Investing, which I don't make a dollar, but it's a great book. And if you reach out to me, area code 805-587-8785 for free consultation, I'll be more than happy to send you the book to you. I'll email it to you. You can read it, and it's a wonderful book to this day. And it just talked about the most actively managed funds from a 5, 10, and 15-year track record, and how they underperform the S&P 500 index. It's incredible, and these are thousands of actively managed funds that claim to be able to beat the S&P 500 index. Well, most of them never did that, and if there is some, then where are they? The adjusted for survivor bias was 1.5% worse, which means this is the ones that were sinking, like the Titanic. They were doing a lot worse, 3% worse than the S&P 500 index. And back in those days, Motley Fool said that 80% of mutual funds underperform the overall stock market. So why would you want to bet on a money manager that's going to beat the market, or the stock market, that is, and have such little chances of winning? Doesn't make any sense. It's almost like going to Vegas. This is from also the information that I got from Morningstar, and great source of information. But here's the problem, and the problem is usually it's cost. And actively managed funds are anywhere from 2 to 3% a year minimum. Let me explain to you why. When a money manager says that they only charge 1%, they're right, 1%, but they don't tell you the other charges that the company collects, like sales charges, 12B1 fees, fund expenses, and transactional cost. That's the other 1 or 2% that is an add-on. So the 1% is misleading in terms of overall cost. It's just the cost to manage the fund. And John Bogle, the founder of the Vanguard Group, said a giant additional cost, all of them were pernicious as being invisible. And he was referring to the hidden costs of portfolio turnover. In other words, every time you turn over your portfolio, change the investments, if you like, they estimate 1 full percentage point. And it's not even in your statement either, which is really, really tricky. It's in my opinion, it's not right. But that's the way it goes sometimes. Mutual funds are so profitable for everybody but the investor that there are more mutual funds than there are stocks. That's an incredible statement. That was from the Great Mutual Fund Trap book, Bayer and Gensler. And again, this is still applicable today or more applicable today than it was then, because there's more mutual funds now than there were back in those days, meaning in the early 2000 era. Little book, Constant Investing. Again, it's a John Bogle book. Very good book to read if you want to read into investments. And it's just incredible how, you could Google and see that there's 20,000 mutual funds and a few hundreds of stock companies. Doesn't make any sense. His book, John Bogle, the little book, Constant Investing, did some studies. They did a $10,000 investment, 8% annual growth without expenses for 50 years. It went from 469 down to 145 with 2.5% annual expenses. That is what you need to avoid. Avoid expenses or minimize it at the very least. If you can avoid it, that's wonderful. If you could lessen it, that's a lot better. And over the course of these videos that I do, you'll see how to lessen the cost and in some cases avoid it entirely. And this is a source of the little book, Common Sense Investing with John Bogle, the Vanguard Group. He did another study, and this study was $10,000 from 1980 to 2005. And again, even though the years are back, in the early 2000 era, it's the concept, it's the premise, it's the idea behind it, and it's still applicable today at 2026. The average equity mutual fund did 98,200. The index fund, S&P 500 index fund, did 170,800. Big difference. Peter Lynch, which was the very popular money manager for the Magellan Fund back in the 90s, he even mentioned in Barron's that people are better off in the index fund, which is interesting because you manage money. So I guess he had to come out of the closet, tell people what the truth is, what the reality is. In this slide here, it says it's very difficult to choose the right fund. And this is again in the little book of Common Sense Investing, again, John Bogle, the Vanguard. The first should be last. And they just took the top performing funds, and they did well from 96 to 99, but they did terrible from 99 to 2000. And the worst ones did better than the best ones after a few years. The S&P 500 index outperformed the average fund and the average fund investor, Dalbar, a good source of financial information. So my question to people is always, what would be your ideal long-term savings vehicle characteristics? In other words, what would be your ideal investment? Like, what would it look like? And some of the things that I believe that are important, and I'm sure if you're watching this video, you'll probably agree, something that can perform well in a less robust market, because we live in a time where the market's not going to perform as high as it usually does, at least not consistently. Reduce or eliminate risk. In fact, we're going to eliminate risk, and I'll show you how exactly. Something that's tax efficient. I think we already pay too many taxes as it is, but if we can avoid 30-40% taxes, it's not a bad idea. The other thing is low expenses, and that's one that I've been talking about for a while during this presentation, that we have to lower the expenses. So we use basically a vehicle, an insurance vehicle, that has a cash value growth linked to 140% of the S&P 500 index, guaranteed not to go down if the market declines. So if the market goes down to negative 50%, you can't lose a penny on that. You have low insurance costs and expenses over the life of the plan. Tax-free growth, in tax-free distributions on the cash value. And then you get an annual reset feature. So in this example here, I can get the caps higher. Even the cap rate is 11%, so you know what a cap rate is. The insurance company says this is the maximum we'll give you. Trade-off is you don't lose a penny when the market declines. But in this case, the market goes 15%. The insurance company caps you at 11%, which I can get it to a higher rate, by the way. But then the market goes down. You stay at 11%, then the market goes up 8%. You go up to 22%, excuse me. And then the market goes down 18%, you're still at 22%. That's where you want to do. You don't want to lose any money. As Warren Buffett would say, rule number one, never lose any money. So in summary, if the S&P 500 index only, and I repeat, only did 5% in the stock market, you're going to get 140% participation rate. That's what the insurance company can give you. And you'll be credited 7%. Now, at a 21% tax bracket, your tax-free growth jumps up to 8.5%. After cost of insurance of the life of the plan, you get approximately 8% internal rate of return. That's not a bad return, especially in today's marketplace. By the way, this is only if the market only did 5%. If it does more, then you get more. But I'm using very conservative numbers, as you can see here. Very conservative numbers. How can the insurance company do it? Well, relatively easy. They take your insurance premium expenses and they invest in high-grade corporate bonds such as Microsoft, Apple as an example. They take a portion of that interest and they buy call options in the S&P 500 index. And they do it in a manner that produces a robust return, 140%, in some cases higher, and a maximum 11% of cap, but in some cases higher as well. It just depends on what insurance carrier we're using. I'm just using this as an example. But they keep doing it over and over. And the bonds provide the principal guarantee. The interest pays for the option spreads, and the options provide the yield. That's how they can do it with no market risk to you or them, because your money's never in the market. This is a great slide. John Bogle, in his book, again, the little book Common Sense Investing, he took a mutual fund versus an index life plan, and he's not in the insurance business, but he was compelled to show this. And he took 1 3/4% dividend on the mutual funds to cover the expenses of the mutual funds. So in other words, no expenses at that point. And the mutual fund is subject to long-term taxation, but it's not high. It's 22% or so, somewhere around there. Anyways, no dividends paid on the life policy. Well, we don't get the benefit of the doubt. But we invested $25,000 per year on both investments for 10 years, and then 10 years after that, your income began. Well, if you look at this, no financial advisor, no money manager is going to show you the kind of numbers I'm showing you. A very conservative approach. 4.5% to 5% and 5.5%. If you look at that, you realize the index life beats the mutual fund on all three percentages. And the reason is taxes. That's the biggest one. Taxes is the biggest one. But here's an interesting quote from John Bogle. He said, "Avoid financial advisors who claim to predict in advance top performing managers. The best advisor can help you develop a long-range investment strategy and an intelligent plan for its implementation. I think you realize that that's exactly what we just did here. I used conservative numbers, very conservative numbers, and we showed you something that no one's going to show you, because they don't. They show you big numbers where you become very enticed to want to invest with them, but then all of a sudden it doesn't happen, and then you get stuck with holding the bag and unfortunately losing money in a lot of cases. This one, our last article, I again, it's, even though it's from 2000, it still stems true today, and in fact it's more applicable today. Said this is the Vanguard Group. He said the taxes and fund costs can chew up 87% of investors' long-term return. So they took a dollar amount, which is easier to look at, 515, and it went down to 65,000 after taxes and costs. Well, we eliminate taxes, we minimize costs, and certainly our numbers are a lot better. Thanks for watching this presentation. If you got anything good out of this, or you have any questions, please feel free to call me at area code 805-587-8785, 805-587-8785, William Ramirez.